Well, we're beginning the reading on arbitrage-free valuation, and the next reading is we're going to actually use what we develop in this chapter to value bonds with embedded options. And that's the whole point of the next two chapters, of this one and the next one, is we're working our way towards valuing bonds with embedded options. Because look, if we have an option-free bond, we can do that straight away. We pretty much know how to do that with the spot rates. But once we have an option in there, it gets a little tricky. So this reading is a quick one, actually. All we're doing is developing the framework within which we will value a bond with an embedded option. So throughout this reading, all we're really going to do, all I want you to focus on, is how that is done. In the next reading, we'll actually do it. So we're just doing the framework right now. So let's go ahead, starting of course with our first learning objective, which is to pretty much introduce a lot of vocabulary and make sure we have straight in our heads the idea of what arbitrage is. So arbitrage is a riskless profit with zero investment. Most people forget that point. It requires zero investment. The principle of no arbitrage: prices adjust until there are no arbitrage opportunities. Law of one price: two goods that are perfect substitutes must sell for the same current price. And of course, we have a caveat here: in the absence of transaction costs. But you know what? In the world we live in today, transaction costs are really so very, very low. I know I use Interactive Brokers, and I know that I could put trades on with multiple legs, and each leg is costing me 70 cents at times to put on. So when you're looking at $10 in for a complex option or a bundle of complex options, that's not a big deal. That's really not a big deal. So you could almost say that transaction costs really don't exist today, because for the most part, as a percentage of what you're doing, it's minimal. It's not even just minimal, it's minuscule. So now we got some vocabulary out of the way, and you should be familiar with this. You saw this in level 1. Level 1 economics, we went through the law of one price. Arbitrage opportunity. What is an arbitrage opportunity? There are two types. First one, value additivity. This means the value of the whole should equal the sum of the value of the parts. So let's say that you can buy an asset for $10. Or you could buy a bundle of assets, 10 of them, for $98. Well, if you could buy one for $10, then 10 of them should be $100. But if you can buy a bundle of them for $98, there are no discounts. There's no volume discounts in the market. Oh, you're buying 300 shares. Let me give you a discount on that. No, it doesn't work. There are no volume discounts. So the sum of the value of the parts should equal the value of the whole. So let's have a look at an example. Asset A, 0.952381. It matures at $1 in 1 year. Asset B is $95 today, matures at $105, and asset B is just a portfolio of 105 units of A. So, well, which one's the more, remember now, if we're going to do arbitrage, buy low, sell high. Which one is priced low? B is priced low. So we would buy B and we would sell A. Well, we got to sell 105 units of A. So if we sell 105 units of A, we will get $100. We have the 100, we buy the B for 95. They'll both mature at 105, so we make nothing in the future, but we'll make a quick $5 today. Buy asset B generates $5 today, 0 at maturity. The second type of arbitrage opportunity is something called dominance. Let's take asset C and asset D. Both are risk-free, same issuer. Let's call them sovereign bonds. This one we pay 100, matures at 105. This one we pay 200, but it'll mature at 220. So which one is low, which one is high? Clearly the 200 returns more. It returns 220 than the 100. So what we would do is we would sell two C's for the $200 we need to buy D. We want to buy the one that returns more, right? So we'll buy D for 200. Notice whereas our investment is 0 and we make nothing today, but look what happens. In one period of time, we'll have to pay back 210 to extinguish C because we're short. But D will deliver 220, thereby giving us a $10 profit. Notice that it's riskless and it requires 0 investment. They will both mature. They're both the same issuer. They will both mature at the same price, at the same time, and the proceeds from one pay off the other with 10 left. So arbitrage-free valuation. Now that we got an idea of what arbitrage is, what is arbitrage-free valuation? This is a process by which we value a bond such that there are no arbitrage opportunities left, and we say that that is the value of the bond. Because if there were arbitrage opportunities left, forces would come to play on that opportunity, negating that opportunity, but also changing the price until it doesn't exist anymore. So we just say, look, let's just go right to the price where no arbitrage opportunities exist. An approach to security valuation that determines security values that are consistent with the absence of arbitrage opportunities. All right, well, before we move ahead to the valuation framework we're going to be looking at, let's just try our hand at a few things here. Bond A is a 3% 10-year annual bond yield to maturity of 2.5%, is listed in New York. It also sells for 104.376 in Chicago. Is there an opportunity here? Well, let's value the bond, and this one actually is fairly straightforward. N equals 10. We can just do this on our calculator, right? Payment equals 3. The required return on this one is 2.5. What is our future value? Future value is always 100. And compute PV. And we will get 104.376. 104.376. Actually, it'll be negative. I'm just making it positive. So no, there are no arbitrage opportunities here. That one is priced right now. If there were, there'd be buying and selling that comes into play that pushes up the price of one and lowers the price of the other. So let's have a look at bond B. Let's see if we can demonstrate that here. 3% 10-year annual, yield to maturity 3.2 in Hong Kong. Sells for 97.22 in Shanghai. Do we have an opportunity here? N is equal to 10. Our payment is equal to 3. Our return is equal to 3.2%. Future value is always 100. And our present value, once we compute that, will be 98.311. So what do? We have an arbitrage opportunity. We follow the general law of investing: buy low, sell high. So where's the low price? It is 97.22 in Shanghai, 98.31 in Hong Kong. It's lower in Shanghai, so we will buy in Shanghai. HAI, and we will take that bond and we will immediately sell in Hong Kong. Now, here's what's going to happen. As we start buying in Shanghai, we're going to push the price of this bond upwards. As we start selling that same bond in Hong Kong, we're going to push the price of that bond down until that opportunity disappears, and that's where the price will stay. As soon as it gets out of line, our system will hit it again. Okay, so let's look at a sort of a longer example here. Let's say that we're given these par rates, 1 year, 2 year, 3 year par rates, and we're looking at a 3-year 5% annual bond at 102.7751 with a yield to maturity of 4%. Is this an arbitrage-free value? And this, we don't really need more than our traditional valuation framework, which means we estimate our cash flows. That'll give us our numerator. We select a discount rate. In this case, we're going to use the spot rates per period, and we're going to compute a present value. So let's find our spot rates first of all. That's what we need to do. So what are our spot rates? Well, 100 must equal, we have the 1 year is 102, discounted at 1 plus R1. It doesn't take much to see here that R1 is exactly what that is, 2%, right? Our next one is 100, must equal. It's a 3%, so we know we have 3 discounted by the 1 year spot rate plus 103 discounted by 1 plus R2 squared. And we solve for R2. We will get 3.015%. And we finally need R3, which is 100 equals, what's our payments? 4, 4, and 104. 4 discounted back by 1.02, plus another 4 discounted back by 1.03015, plus 104. 1 plus R3 to the power of 3. And that will give us R3 equal to 4.055%. There we go. So now we're in a position to find out if this is an arbitrage-free value. It's a 3-year, 5% annual bond. So we need a present value for this. What are my cash flows? 5, 5, and 105. Great. What are my discount rates? 1.02. What's the next one? 1.03015 squared. And what's my last one? 1.04055 to the power of 3. I get 102.8102 versus 102.7751. Is this an arbitrage-free price? No, it is not. So what will we do? Buy low, sell high. We're going to buy the bond, and we're going to sell each of the cash flows. Now, you're probably wondering, well, how do you do that? Well, you got to be a dealer. That's the big thing, right? So does arbitrage break down if you can't do it? If you can't sell these separate cash flows as zero coupon bonds, does arbitrage break down? No, because all that's required for arbitrage to hold is a few significantly large enough players that can do it. And if they can do it, they will. Now, here's an important point. This is our traditional valuation framework. This will not work with bonds with embedded options. I want to get that in there so that you see it. This will not work with bonds with embedded options. We need a new way to value that. But here's the deal. The way we come up with to value bonds with embedded options must also work for non-option bonds, for bonds that are option-free. So what we just did here, coming up with the value of 102.8102, whatever framework we develop to value bonds with options has to be able to do this one as well, has to be able to deliver us that price, that once we use that framework with this bond, and we better recover this price. We better get this price. All right, so now we're going to just describe the binomial interest rate tree. We're not going to get into too much detail about it. We're just going to describe it. So, to recap, for an option-free bond, discounted cash flows with spot rates will give us an arb-free valuation. But not so with embedded options. Bonds with embedded options have cash flows that are interest rate dependent. What do we mean when we say interest rate dependent? Let's take a callable bond. As interest rates drop, the probability of a call increases. So, if interest rates are going up on a callable bond, we don't have to worry. But as interest rates are going down, it may be called, thereby changing our cash flows. Well, we're not discounting all the cash flows anymore. We're discounting other types of cash flows, right? We need an approach that derives an arb-free valuation for both option-free and embedded option bonds. They must do both. Therefore, the valuation framework must allow interest rates to take on different potential values in the future based on some assumed level of volatility. Up to now, in the traditional valuation framework, we were concerned about the path of interest rates. We really didn't include volatility at all. We just included the path. And we'll see later on that as we introduce volatility, it won't change the price of an option-free bond. It'll just change the value of the option in a bond with an embedded option. So we're going to see how that plays out. But we now must include not just the spot rates, but we must say, well, let's put some volatility in there. All right, well, here's what it looks like. Looks pretty ugly, right? But let's just start at the very beginning. We'll break it down. You'll see it's actually very, very simple. We're going to start with the current one-period spot rate. Right there, I0. That's the current period spot rate. By the way, all of these dots here, all of these circles, these are called nodes where we'll find an interest rate. There's an interest rate. They're called nodes. This is the root node. So the root node will have the current one-period spot rate. Well, next period, rates could go up or rates could go down. If rates went up, guess what? Next period, rates could go up or rates could go down. If rates went down, next period, they could go up or they could go down. Notice here how they recombine. So that we have one interest rate, then two, then 3, then 4, 1, 2, 3, 4, and if we went out another one, we'd have 5, then 6, then 7, then 8, as opposed to a normal binomial tree, which would branch out like this and start to grow exponentially, right? That would be really difficult to follow. This recombines. Since it recombines, we refer to it as a lattice model. So if you're wondering what that term ever meant, now you understand that the term lattice model means they just recombine such that at each progression we are progressing, we add interest rates, or interest rates grow linearly, not exponentially. So here's all our rates. Here's the choice. Interest rate at time 1, high. Interest rate at time 1, low. Interest rate at time 2, this was high, high. This was high, low. This was low, low. This was low, high. And you can follow it through like that. So how do we get our high rate and how do we get our low rate? Well, if we just draw a little dotted line all the way through here, that will be our forward rate. Those will be our forward rates. So we have our current 1 period spot rate. 1 period from now, we're going to look at the spot rate for F11. Notice I've got it written in here, F11. And the high and the low rates are centered, nearly centered, not quite centered, but nearly centered on that spot rate. When we get to I2, the middle rate here will be very, very close to F21, F21, and of course we have our low rate and our high rate. As we move out, the variability in the rates increases. The spread between the highest HHH and LLL increases each time. We'll see what kind of relationship that looks like. And this is for a given level of volatility. At a higher level of volatility, these will be wider apart. But here's the deal. If you add this rate and this rate together and divide by 2, you will get the spot rate. That's how these rates must be. That doesn't mean we just simply add the same amount to the top and to the bottom. We'll see that's a good way to start, but that's not necessarily how it ends. But there you go. You get the general idea. We're going to start with the current 1 period rate, and we're going to figure out, well, what do these two rates look like? Then what do these look like? Then what do these look like? And then we're going to test if those rates are consistent with this forward curve. If they're not, we'll make some modifications and retest it again until we've calibrated this with the proper interest rates. Then we're ready to go. So, in what we're going to do in this chapter, only one rate, the current 1 period rate, only one rate is being modeled. Sometimes you could do a short rate and a long rate at the same time. Only one rate is being modeled, so we call it a one-factor model. Our goal in all of this is to populate the tree with interest rates. That's our goal. All we want, in the end, when we're done, all we want is a tree with interest rates. Great. Now we can throw some bonds at this with embedded options, which we'll do in the next chapter. And honestly, you'll see how easy it is. Once we get the interest rates in, everything's easy. Easy peasy. So the goal is to populate the tree with interest rates under certain constraints. And we'll see what those constraints are. So we're going to need some forward rates in which to begin with. So let's say that we observe the following par rates. I'm not going to go into detail about my problem with the 3-year and the 4-year. You already know. But let's say we observe the par rates. That means present value is 100. From the following par rates, we can uncover the following spot rates. We know how to do that with bootstrapping. Once we have the spot rates, here's all our spot rates, 1, 1.2, 0.1, 2.51, etc. We can then uncover all of the forward rates. We already know how to do that, so there's our forward rates. These are the rates we need. So if we're given par curves, we have to move over to our spot curve, then we have to get our forward rates. We have to uncover those forward rates. Once we have that, we're ready to proceed. All right, let's look at how we generate an interest rate tree. The first thing we do is put a little dot on the page and put the current 1 period spot rate in front of it. Based on the example I gave you on the last screen, our current spot rate is 1%. That's the current spot rate, that's R1. That's at time equals 0. At t equals 1, we're going to need some rates. How do we move from t equals 0 to t equals 1? Well, we need a couple of things. Number one, we need an assumption about volatility, because we got to know, well, how high do we go? How low do we go? Well, what's our assumption about volatility? We can get that in two ways. We can look at historical volatility, and if we think that, well, the future is going to look like the past, for the most part, volatility should stay constant, we can use that. Or we can use implied volatility. And implied volatility is based on observed prices of interest rate derivatives. If you are familiar with Black-Scholes, if you have 4 of the available inputs and you need to get if you have 4 of them, you can figure out what the price is implying about what volatility would have equaled. That's why it's called implied volatility. So you need an assumption about volatility. That'll pretty much be given to you. In every problem we do, let's assume volatility is this. Then we need an interest rate model. An interest rate model. And an interest rate model is just saying, well, how are we going to progress? How are these interest rates going to progress over time? How is volatility going to progress as rates progress? So this is what we're going to use. We're going to use a log normal random walk. Log normal can only take on positive values. When we talk about log normal random variables, they are random variables that only take on positive values, therefore no negative rates. The other feature that the log normal random walk will provide us with is higher volatility at higher rates. Not to be confused with higher volatility with shorter rates. Remember, we talked about that before when we looked at the term structure of volatility, that shorter rates had higher volatilities than long-term rates. What we're talking about here is not the term, we're talking about levels. So as we move high and as we move low, remember, when we keep moving higher and higher, these higher rates will eventually have higher volatility. This log normal random walk, this interest rate model we'll be using, allows it to happen. In other words, that's included in part of the model that we will get higher volatility at higher rates because of it. Okay, so let's start moving beyond the root node now. Let's say that we want to figure out what our interest rates will be on the lower side and on the higher side at our first time period. This, by the way, we always label as t equals 0. This will be t equals 1, and we denote our interest rate I1. And notice that's I1, that's I1, it's the same one. The same way I1L means low and then high. So you can imagine, and we don't actually draw it out, but you can imagine a dotted line from here straight out. So no matter how big this tree gets, there's this dotted line along here. And this rate in here, the middle rate, is going to be F11. Remember, it's centered on F11. And what we want is we want to get one standard deviation above, whatever this rate is, one standard deviation above, one standard deviation below. This is our measure of volatility. And it'll be given to us. We might assume volatility is 10% or 15%. So if it's 15, that'll be e to the power of 0.15. This will give us not the rates we need. This will give us our best guess at what the rates will be. To actually get the real rates, there is no formula. That's the unfortunate thing. There's no formula. So what we want is a good starting point. From that starting point, we would then take a 1-year zero and calibrate this rate to see if we recover a price of par. If we don't, we would tweak these rates. We would basically just tweak this bottom rate. We wouldn't tweak the top rate. We'd tweak the bottom rate, and here's why. We only deal with this one. This is our first best guess, and then we would only deal with this one. Here's why. This top one is 2 standard deviations above the below one. It must be 2 standard deviations. So whatever adjustment we make here, it is easier to calculate this rate up here by simply taking whatever rate we get here and multiplying it by e to the power of 2 sigma. If this is a negative sigma and this is a positive sigma, it's easy to see that this rate up here is 2 sigmas away. So in your spreadsheet, you would just program this cell to be whatever this rate is times e to the power of 2 sigma. Adjacent cells are 2 standard deviations away. So just to make sure that we got it, let's move to the third, to t equals 2. This over here will be t equals 2. If we had 2 rates here, we now have 3 rates, and I said you can imagine that dotted line going all the way through. So what rate are we going to be looking at here? We're going to look at the F21 rate, the forward rate there. This was e to the negative sigma. This will be I2 e to the negative 2 sigma. The next one would be to the -3. The next one would be to the -4, etc., etc. This rate up here is I2 e to the 2 sigma. So how many standard deviations away are they? Well, we've gone from a 0 line, -2, and then we've added 2, so we can see these are 4 standard deviations away. Again, this is our best guess as to what those forward rates will be. Forward rate under this condition, a forward rate under this condition, a forward rate under this condition. They're all t equals to time period 2 forward rates. So it's not going to be exact. We're going to be close, but we're not going to be exact, which means we're going to want to change this one. We're going to modify this after our first pass. If we were too high or too low, we'll modify our rate, and we'll try calibrating a 2-year zero again. And we'll see if we can recover the price, or a 2-year par, and see if we can recover the price. And we'll just keep modifying this until we actually get it right. So once we modify this, we would like this rate and this rate to fill in on its own. We don't want to have to modify this and keep guessing as to what these are. Well, we know that there is a relationship of 2 standard deviations. So to get I, the high-low and the high-high, we just take I2, low-low, multiplied by e to the 2 sigma will give us this rate, and multiplied by e to the 4 sigma will give us that rate. When I say this rate, I mean that rate there. So in your spreadsheet, you would just program each cell with this formula, and then when you change this value by how many basis points, these two will automatically change, because you can't add the same amount of basis points to each one. You must, because they have to maintain a 2 standard deviation separation, which means if you change this, the last thing you want to do is get your calculator out and calculate up and then calculate up. It's easier just to program your spreadsheet to do that. All right, well, this is what it'll look like hope in the end, or at least this is the sort of the framework. We don't know what it'll look like yet until we fill in all the interest rates, but this is what we're going to work with. This rate right here is the 1-period spot rate. The rate, and again, like I said, you can imagine this invisible line in the middle. So at t equals 1, we're going to be using F11. At t equals 2, we're going to be using F21. At t equals 3, we're going to be using F31. So it's easy to remember 1, 2, 3, 1, 2, 3, and each forward rate is for 1 period. Notice that whatever our forward rate is here, look how we get our first guess. This is our first guess now on the upper and lower bound. It is the forward rate multiplied by e to the power of sigma. The next one is e to the power of 2 sigma. This is e to the power of 3 sigma, of course, with the proper forward rates. Negative sigma, -2 sigma, -3, and if it continued on, it would be -4, -5, -6, -7. So this is our best guess as to the upper and the lower rate. This rate right here will be very, very close to whatever F21 is. So that would be our starting position. We'd put F21 here. We'd go down 2 standard deviations, up 2 standard deviations. Great place to start. Now go. When we get out here, it becomes a little bit trickier, right? So we have e to the -3, because we don't actually use this rate. Well, this is e to the -1 standard deviation, because remember, they're all 2 standard deviations apart now. If this is e to the -1, this would be e to the 1, and then e to the 3. That's nice and simple. So once you get the idea, it's like, well, I take the forward rate, 1 standard deviation up and down, calibrate this. Once I'm done that, move on to the next term. Here's my forward rate, 2 standard deviations down, 2 up, calibrate. Move on to the next. I go 3 down, 3 up. Then from here, I'll go 2 up, and from here, I'll go 2 down, or whichever way you want to go. You get it, right? Once all the first past interest rates are populated, so once, and we don't do it all first. No, we don't do it all first. We do the first tree, the first branching, we calibrate it first. Once we're there, we do the next branching, we calibrate it. Once we have that solid, we do the next. So before we move on to these rates will be rock solid. They'll be absolutely perfect. Then we'll move on to this one and get that perfect. Then we'll move on to this one and get that perfect. It says here we use par yields to calibrate the tree 1 time step at a time. Okay, well that gives us a nice overview of how we're going to get our rates in place. Now what we have to do is calibrate that tree, like we said, one step at a time. So to calibrate it, we first have to learn something called backward induction. This is actually, once I show you the first step of backward induction, you'll get the rest. It's very easy, and then we'll calibrate a tree after that. But let's assume that this tree that we're looking at are the rates that we're going to use. This is a tree that, let's just say it's calibrated. And now what we want to do is we want to find the price of a 3-year annual 5% bond. Notice that this 2% here is our current spot rate. These two rates right here correspond to F11. That's our forward rate is somewhere in there. The 5% is 1 standard deviation above. The 3% is 1 standard deviation below. Then our F21 rates would be in here. This is a 3-year bond. So the way we would read it is if we have 3 years, this is our payoff. What do we get at the end of the term? We're going to get our par value plus we get our last coupon. Remember, the last coupon occurs on the very last day. So if we think about it, here's year 1, here's year 2, here's year 3, and there's our payoff. We start backwards. We work our way backwards to the beginning because here's what we know. We know this. No matter which way interest rates go, we know this. We know that no matter what path we take, at the end of 3 years, we're going to get $100 or we're going to get par plus our last coupon of 5, no matter which way we go. And what we assume throughout here is that each branch is equally likely, 0.5, 0.5. Here, from 5%, we have an equal likely probability of going each way, so 0.5. What we want to do is we want to find the value at each node by bringing back the tree. So it's actually quite straightforward. Let's go ahead and do one right now. So for this one right here, here's what we're going to do. Our value is going to be 0.5 times, we have 105 coming in, discounted back at 1.08, plus, and then we have 2 branches coming out, 0.5, and we have 105 coming back at 1.08. So you can think of this as an average. In fact, because they're equally likely, you could just say, well, we're doing an average. You could put the 0.5 on the outside and just add the 2 together. We will get 97.2222. But we do not put 97.2222 here. We add 5. We add the coupon. So our value here is 102.2222. Now, we add the coupon before we bring it back. You can just as well write it as 97.2222 plus 5, but you can just add it right in. Why are we adding this coupon back? Because we're trying to, our next step, after we have all of these values, our next step would be to find the value here. Well, the value here consists of what cash flows? 5 here and 105 here. Now, if you don't add the 5 to this, how would you find the value here? Well, you'd discount 97.2222 back one period. Then you would discount the $5 payment back one period. So why do 2 separate moves? Why not just add it, right? So how do we find the value here? Well, V0 equals 0.5, because 0.5 this way is 105. 105 over, the rate here is 1.06, plus down here we have 105 over 1.06, and of course that's by 0.5 as well, and we will get 99.0566. Bring it back to here, but we add the payment on, brings it to 104.0566. That's what we're going to bring back. And finally, our value here, 0.5 times 105 over 1.04 this time, and 0.5 over 105 over 1.04. And if we bring that back, let's see, we get 100.9615. 105.9615. These last ones are really straightforward to do. In fact, you only have to figure out 100 over 1.08 and bring that back, because the next one's exactly the same. So why do 2 calculations and then divide it by 2? Whenever you're at the end of a tree, all you have to do is just, okay, for the 8%, just do one calculation. Bring 105 back at 8%, add the payment. bring 105 back at 6%, add the payment, bring 105 back at 4%, add the payment. But you cannot do that here. Because look at this, we're going to bring back 102.2222 at 5%, half of that, and we're going to bring back 104. Notice that these are different now. Once you start moving from the payoff inwards, it becomes a little bit different. So we add our coupon payment here, and then we bring back the 102.22 at 0.5. So we'll have 0.5 at 102.2222 divided by 1.05 plus 0.5, and the value here is 104.0566 over 1.05. And what value will we get for that? We get 103.228. Plus 5 equals 103.228. Sorry, I added the 5 in automatically because, of course, from this perspective, there's a 5 here, there's a 5 here, and a 105 there. So this is our 105. We've added the 5 here, we've added the 5 here. We have all our cash flows. And then, of course, you bring this one back, and how do we do that? 0.5 of 104.0566 divided by 1.03 plus 0.5 of 105.9615 discounted back at 3%. And, of course, you add your 5. We will get 106.9506. And this last one over here, we don't add 5 to this one because there is no cash flow at time 0. The first payment starts here. We just bring back 103.228 at 2%, and we add that to 106.9506 at 2% and divide by 2. We will get 103.0287. So that is how we do backwards induction. Now we're going to move on and actually see how we calibrate these rates. We have everything we need to calibrate rates now. We know how to get our starting rates, and we know how to calibrate it using something called backward induction. So let's move on to that. All right, so now we're going to begin calibration, and we're going to use the example from the top of the chapter, where I introduced the par curve, the par yields, and we derived our spot yields from it and our forwards. And I'll introduce them across the top as we go. So what we're going to use is the 2-year par bond, 1.2%. Our forward rate, you'll recall, we calculate at 1.4%, and our 1-period spot rate was 1%. We're going to assume standard deviation or volatility of 15%. Let's see how we do this. Well, we use 1%. Now, we're just going to calibrate these rates right here. And you may be thinking, well, why wouldn't we use a 1-year bond to calibrate that instead of a 2-year if we're calibrating the interest rates at t equals 1? Why are we using a 2-year? Well, if you think about how bonds are discounted, if we have a 1-year bond, we discount it at R1. Well, we already have R1. If we have a 2-year bond, we discount it backwards at F11 and then R1. So we need a 2-year to calibrate the rates here. Remember, this 1% is the rate for the period. The rate we get here is the rate for the period. Whatever value we get here, we discount back by this rate. So we need payoffs here to find these. So let's begin. What do we got? Let's start with our payoffs because that's the easiest place to start. It's a 1.2 par yield, so it's 100 plus 1.2 at each of the nodes, plus 1.2 and 100 plus 1.2. So we need a starting rate to discount it back by. Remember I said you can do this. What's our F11? It's 1.4. So we want 1 standard deviation below, 1 standard deviation above. So we can take the 1.4, multiply it by our measure of standard deviation, which is 0.15. We'll get 1.4 times 0.15, and that'll give us 21 basis points. So if this is 1.4, 21 basis points down is 1.19, and 21 basis points up is 1.61. All right, I'm going to take a little step out here, and I just want to explain what I've done here. You'll notice that I'm just multiplying the forward rate by the standard deviation. Technically, if you're programming a spreadsheet, that's the wrong way to do it. I'm going to show you the right way. Why am I doing this if this is technically the wrong way to do it? This is just a shortcut. This is just a way that I can get there quickly without having to do a lot of math. But if I were programming this cell in a spreadsheet, We really should do it right because this is a log normal process. This is a linear process. It's not technically correct. But again, the value you're going to put into these nodes is your first best guess. And I find that you'd never solve one of these outside of an algorithm. You'd never solve one by hand. So I find that just for demonstration purposes, just getting some starting value in there that's a number of standard deviations away is fine. But let me show you how to get this number correctly here so that we get it. It is going to be the spot rate, 1.4 e to the negative sigma for this rate up here, which means it's going to be 1.4 e to the negative 0.15. Our first best guess on this rate is going to be 1.20499. How do we get this rate up here? We multiply that by e to the 2 sigma. If you multiply that by e to the 2 sigma, you'll get 1.62656. By the way, this is also equal to the spot rate multiplied by e just to the positive sigma. So of course, all you have to do is program these cells, and then each one of these nodes will be just a multiple of this. So because this is a log normal process, this is technically the right way to do it within an algorithm. But we know that whatever we put here is our best starting guess. I have found that this procedure gets me closer than this procedure, but this is a linear process. I'm just taking a shortcut, and upon reviewing the video I noticed that I'm not explaining that I'm taking the shortcut. That's all I'm doing. This is a shortcut. It's a sloppy shortcut, all right? But it's just a shortcut, that's all. This is technically the right way to do it. You'll see on the next problem, the next tree, when we go to the next node, I still continue to use this because, again, it's just the quickest way to do it. I know what I'm putting in here is the wrong number. The calibration will tell me which way to go. I find I get closer using this, so just to be clear, let's be formal. That's a good starting point. So we'll start at 1.19 and 1.61 and see what we get. Now, these are not the right numbers. I know that right away. They're not the right numbers, but I just want to show you how this process of iteration works. So let's begin. We need a value over here. V equals, and of course it's 0.5 times 101.2 over 1.0161 plus 0.5 of this root is 101.2 over the same discount, 1.0161, and that'll give us 99.596496. And to that we will add our coupon of 1.2, and this gives us 100.796496. We'll do the same thing here. And this time I won't do the whole thing. All we have to do is just discount one of these back, 101.2 over 1.19, because why take half of that and then do the same thing and take half of it to get again, right? This will give us 100.009882. We will add our coupon payment of 1.2 over here, 101.20988. And then our value here is 0.5 of 100.796496 over 1.01 plus 0.5 of 101.20988, 1.01, and we will get 100.0033156. All right, there's my first pass. There's my first best guess. I need to recover the price of this bond. If I recover the price, I know my rates are calibrated. I need to recover par. Well, I've got this. I'm too high. So, therefore, if I go down to 1.19, 1.19 is too low. It needs to be higher. I need to discount by more than 1.19. So my next iteration, I would bump it up. And yes, that's what you have to do. There is no closed form formula for figuring out these rates. You have a nice starting point. You get your rate. You say, okay, we're a little too high. Let's go to 1.19 2. So I might say that my next iteration is 1.192, and then I would try it again and see what I get. And I would keep going till I have absolutely 100 up here, 0. It's easier to do in Excel, because in Excel you just have to type in 1.192, have a look at that, 1.1925, 1.193, and just keep going until you actually get the rate. We'll introduce the exact rate later on, but once you get 1.19, whatever you get here, remember now in your spreadsheet, this up here must be programmed as E. Whatever this is, multiplied by E to the 2 sigma, and this rate will fill in automatically. On our first pass, we actually did a calculation to get this rate and a calculation to get this, but remember, this is 1 standard deviation up, 1 standard deviation down. Once you change this rate, you just want this one to calculate on its own with E to the 2 sigma. And every time you enter this, if you program your spreadsheet correctly, all you have to do is just watch this cell, and you can just do it by hitting the keyboard enough times and say, well, I'm happy at 4 decimal places or whatever. You'll get to it. Okay, so these are the rates that you would get if you calibrated that last on the last screen. If you continued your iterations, you would have arrived at 1.1943, 1.6121. Notice how close we were. We started at 1.19 and 1.61. So when we say it's our best first guess, it's pretty good. And we got to 4.3. This cell is 2 standard deviations above this one. You can simply do the math and find that this one results in 2 standard deviations above. Notice we added 43 basis points on here, but that doesn't mean that we add the same amount of basis points on there. So that's why this cell should really be a mathematical result of this cell as opposed to entering it independently. Let's figure out what the rates are for this term, and I'm not going to do all the calculations. I'm just going to do the broad strokes here in what we're trying to get done. So our forward rate, we're going to calibrate it with a 3-year par, 1.25. So we know our payoff is going to be 100 plus 1.25 on each of these. Now we need some rates to bring it back. These rates are perfect, so we never have to touch these again. We just want to get these. So we need a rate that is 2 standard deviations below the forward rate, the F21. Do we have an F21? It's 1.35. And we need one that's 2 standard deviations above. So how I normally start this one, I say, well, our best guess here is the forward rate itself, 1.35%. Why don't we just start there? We know that this one is going to be 2 standard deviations below, and this one is going to be 2 standard deviations above. So let's figure out in basis points how much is the standard deviation. F21 times sigma will give us 1.35 times 0.15 is 20.25 basis points. So if I want to know what I2 low is, which is this rate down here, it will be my forward rate, F21, minus 2 standard deviations, which will give me 1.35 minus 2, 0.25 BPS, and that'll give me 0.945. So there's my best guess, 0.945. So that's 40.5 basis points. I can go from 1.35 to 1.755. That's 2 standard deviations up, 2 standard deviations down. Here's the thing. I know they're wrong. I know they're not right, but it's my best starting point. And then I'll bring all of these back, and of course I will be wrong, but it'll tell me whatever number I get here. If it's over 100, then I know that I need to increase this. If it's less than 100, I know I need to decrease this amount. It tells me what direction to go in. If you go all the way through, you'll find that this rate is 0.9803. So to get this rate up here, I simply multiply this by e to the 2 sigma. To get the rate up here, I must use the base number down here and multiply that by e to the 4 sigma. And I will get 1.7862 here. I will get 1.3233 here. So now I'm calibrated for I2. There's my set of forward rates at I2. Okay, and we just need another set of rates. We have our t equals 0, t equals 1, t equals 2. We just need our t equals 3 rates and we're done. We use the 4-year par for that. We have 1.4. So we know that our payoffs are going to be 101.4 on each of these tree branches. 101.40, 101.40, and we just need some good starting rates to start with. So let's figure out what one standard deviation is. We're going to use F31, and we're going to multiply by our standard deviation, which gives us 1.86 times 0.15. We get 27.9 basis points. So we know this is one standard deviation down. This is 2 standard deviations down. This is 3 standard deviations down. So I3LLL is equal to 1.86 minus 3 times 27.9 basis points. And here that will give us 1.023. There's a good starting point. And we simply just add 2 standard deviations on, plus 2 standard deviations. Well, 2 standard deviations, we just multiply this by 2, add it to here, we'll get 1.581. Add another 2 standard deviations on to get to here, we'll get 2.139. Add another 2 standard deviations on, we'll get to 2.697. So once we know what the standard deviation is, 27.9, we can see that we're adding 27, 54, 55.8. Each time we go up, we're adding 55.8 basis points on the way up. Just a starting point. Remember, it's just a starting point. We will have programmed our spreadsheet to be 2 standard deviations above this number. All these 3 will be a mathematical result of this. So once we do backwards induction and get a price, we'll keep doing it to, we'll change this number in our spreadsheet till it equals 100. And if we do that, here's the numbers we're going to get. Our base number down here is 1.1521. To get the next cell up, we multiply that by e to the 2 sigma. We'll get 1.5552. Our next one will be multiplied by e to the 4 sigma. Will give us 2.0994. And this one way up here is multiplied by e to the 6 sigma, will give us 2.8338. So there's our actual set of forward rates we'd be using down here. Once we get that, our tree is calibrated. We're all done. So you can see that if you do this in a spreadsheet and you need to calibrate, you can then calibrate any tree by, again, just one node at a time. Once you're done, you can price out any bond. You can go out 10 trees, but you can still price a 5-year on it. You just don't have to use all of the branches, right? All right, we're going to do a bit of a little bit more detailed problem, and we're going to use sort of a different route than what I've shown you. Although it's the same method, we're just going to use a slightly different route to show you that you can do this 2 ways, do the calculations 2 ways. So here's our par rates that were given, 1 year, 2 year, 3 year. From that, we can derive these spot rates, a 2%, 3.015, and a 4.055. We can find the price of each of these, 0.9804. These are discount factors, recall, 0.9804, 0.9423, 0.8876. These are assuming a 2-year 0, a 3-year 0, a 1-year 0, 2-year 0, 3-year 0, and our volatility is 0.15. So rather than price out the par, we're going to price out the spot now. We're going to price out sub-zero bonds and just see if that's any different, and it really isn't that different. So here's a tree that we're given, and it's wrong. We know it's wrong. We've used this before to price out a bond, but now we want to get precise with this, and it's a matter of, let's calibrate this tree. This is somebody's first best guess. I think we can do better than that. So our root node is 2%. So we're good here. We could put a little check mark there and say, you know what, that's good. The 5 and the 3, I don't know if that makes a lot of sense. So what I want to do is I'm going to calculate my forward rate, because remember, these are all centered around forward rates. So what is my F11? I'm not given F11, but I'm given my spot curve, and I have my spot rates. There's my 2-year, there's my 1-year. I can figure out my 1-year forward rate, 1.03015 squared divided by 1.02 minus 1. And I will get 4.040%. So there's F11. I need this rate and this rate, a beginning rate for those. So what I'll do is I'm going to get a forward rate period 1, 1 down, and a forward rate for period 1, 1 up. There's 1 down, there's 1 up. And, well, 4.040E. This is down, so that's to the negative 0.15, because that's what sigma is. This will be 4.040E to the 0.15. This gives me 3.477%. This gives me 4.694%. Now these, keep in mind, this is my first best guess. Better than 3 and 5. If this is 4, right? 4.04 better than 3 and 5. So this will be 3.477 to start with. This will be 4.694 to begin. How do I calibrate this? I need a 2-year bond. Let's use the 2-year spot. And I should recover the price, 0.9423. Because remember, we can get to the price, 0.9423, by taking 100 and divided by 1.03015 squared. Or we can get to that price by taking 100 and dividing it by 1 plus R1 multiplied by 1 plus F11. Well, that's what these two are, except we need volatility in here. So that's what we're introducing, right? So this should recover the 2-year spot rate. And what is the 2-year spot rate that we need to recover? 0.9423. So what happens here? Well, using our first pass rates, we get 0.9419. 0.9419. So our rates, are they too high or too low? We should have got 9423. We got lower than that, which means our rates are too high. So therefore, for our rates, too high. So we would want to go to 3477 and lower that somewhat, but not much. We're very, very close. 9419 and 9423. We might bring it down to 0.47 and try it from there and see what we get. Then 4.6, then 4.5, and just keep going like that. Anyways, it turns out that the proper rates, if you go through all the iterations, is 3.442, and multiply that by e to the 2 sigma, you will get 4.646%. There's your top rate. Look how close it was, 4.694, 4.646. So they're very, very close. These first pass, the first pass that you get ends up being very close. You just have some little bit of modifications to do, and it is iteration. Let me stress that, it is iteration. Okay, well, let's do the next set of rates that we're going to need. We need our T2 nodes. So we need a forward rate at this point for F21 because we need a starting point. So we'll take our 3-year rate, 1.04055 to the power of 3, and divide it by our 2-year rate, 1.03015 squared, and we'll subtract 1. We will get 6.167%. So if we were going across here, 6.167% looks like our best first guess, 6.167% for this rate. Then we're going to multiply it by e to the negative 2 sigma, and multiply this by E, multiply by E to the 2 sigma. So our best guess down here will be 4.569, and up here we'll get 8.325. And there we go. We want to use, now we're using the 3-year spot at, what's our 3-year spot rate? 0.8876. So we'll put 100 on each of these at each payoff, and we'll discount all of it back. We'll do backwards induction to see what price that we recover here. And let's see what we get. The tree produces 0.8866. Oh, look how close we are. We're off by 10 basis points. So the rates, our starting rates, are they too high or too low? Well, here's the price we were supposed to recover. We got a price that's lower. Remember the inverse relationship. If the price we recover is lower, it means the rates are too high. If the price we recover is higher, it means the rates are too low. And therefore, we can say these are too high. So we would modify this, and of course these two would just change on their own because we've already programmed the cells to do the multiplication. And our actual rates are 4.482, 6.051, and 8.167. Notice from 5.569 to down to 4.82. Remember, these were too high, so they had to come down, right? It dropped to 4.82. We went from 167 to 051, and this went from 325 to 167. So they all dropped down. As soon as you drop this one down, since this relationship holds, it just multiplies this by 2 sigma, or sorry, e to the 2 sigma, and then multiplies the top one. I should put that in explicitly. Our first best guess, we can go ahead and do this. After this, we want to multiply that by e to the 2 sigma and multiply this by e to the 4 sigma in our spreadsheet to keep that relationship intact. So here we are. We have our entire tree and our rates all calibrated. So let's see if we recover the 8876. We have our 100 at the end. If you discount these back, you will get 0.9245. This discounted back will give you 0.9430, and of course the 200s discounted back this way, 0.9571. Discount these two back, 0.5 of this, 0.5 of that, 0.8923. Discount these two this way, 0.9184. And finally here, notice I'm not adding any coupons to this because this is we're using a 3-year spot rate. We're discounting back a 3-year 0 coupon bond. Notice the payment is just 100, right? And this will give us 0.8876. 0.8876. We can say that this is calibrated. Great. So we've calibrated it now. Now we can use it to price things. That's the first step. This is how we build a tree. Is you have to start here at your root node, add your first forward rates, calibrate it with a 1 year par or a 1 year 0. Add your second ones, calibrate that. If you have 3, 4, 5, 6, you have to calibrate the tree one time step at a time. This is called, I wasn't sure if I was clear earlier, this is called a time step. All of these are called a time step. Typically, these would be 6-month time steps, semi-annual, because you'd be pricing out semi-annual. If you want to get really complex, they might be quarterly, and you might be pricing out quarterly steps along the way, which means you're not doing this in a spreadsheet. You're not doing this by hand. You'll never do this out there. You'll never do this. You'll never. But you must understand the algorithm behind the screen. When you're looking at the price, when the software throws you out a price and you're looking at your screen, you must understand how that algorithm works in behind so that you understand the implications for price when volatility changes, when interest rates change, how they change, what if interest rates and volatility were changing at the same time. Understanding how the model works in behind will tell you what effect you should expect to see. But you'd never actually calculate it yourself. But listen, We can't let the machine do everything blindly, because if the machine breaks down, who's there to fix it, right? We have to know what's going on behind. But it would be extremely doubtful, other than just some test, that you'd be asked to do a spreadsheet for a 10-year semi-annual bond using a tree. Calibrate it, please, and calculate the price of this bond. There's just no time for that. All right, as our last step, we've calibrated this. We just need to confirm it. And I said at the very beginning, this has to work for coupon-paying bonds, like zero, no option or option-free coupon-paying bonds, and bonds with embedded options. So before we go any further, let's just take a bond that we did earlier, a option-free coupon-paying bond, a 3-year annual bond, 5% coupon. We priced it out earlier in the chapter at 102.8102, and a yield to maturity of 4%. Let's see if this calibrated tree can recover this price using these rates here. Now we're introducing volatility. Before, when we priced this out, we just said, well, what's our N, what's our IY, what's our PV, what's our FV, what's our payment, and we calculate it. Well, let's use this tree and see if we can calculate the price of this, right? So let's change our pen here. What is our payment? 105. 105. 105 in all cases. 105. And, it's not hard to figure out, 0.5 times 105 discounted back by 1.08167 plus 105. 1.08167 will give us 97.0721. And of course, we add 5 at each node. So our value here will be 102.0721. We do the same thing here, 0.5 of 105 over 1.0651 plus. I don't have to do this. Again, I'm taking 2, adding them together, and then dividing them by 2. For the last nodes, you really don't have to do that extra work. 99.0090. Add the 5, 104.0090. And our value here is 105. I'm not going to do the 0.5 this time to show you that you get the same thing. Over 1.04482. This will give you 100.4958. Add the 5, we get 105.4958. Okay, let's find the value here. I don't think you need me to write out all the calculations here. We're going to, 0.5 and 0.5. It's 102.0721 discounted by this rate. 104.0090 discounted by this rate. Add them together, divide by 2. Add the 5, 103.4658. If you're using the video notes, you'll notice that I do all the calculations for you, but in here you don't really need it done. Do the same thing here. It's 104.0090 and 105.4958 discounted at this rate. Add them together, divide by 2. Add the 5, 106.2668. Finally, one more step. We do the same thing, 102.8101. 102.8102, 8101. If I hadn't rounded off all the way through, I would have recovered the price. There we go. We've calibrated this tree by using our spot rates, or using our forward rates, and discounting it back with zero coupon bonds, just to calibrate it. Once we've calibrated it, we've confirmed by taking a coupon paying bond with a price we've calculated with the traditional method of discounting cash flows, and use the tree, and we recovered the same rate. So this tree is now ready to price out a bond with an embedded option. We get to see that in the next chapter, but now we're ready. All of this work in this chapter wasn't to price out a bond. We already know how to price out an option-free bond. We were just setting up the framework we need to now begin to price a bond with an option in it, and we'll do the same thing. We need backwards induction, and at each node we'll make a decision whether a bond is called or put, and that changes the cash flows. So we'll see how absolutely simple it is when we get to the next chapter to start pricing out bonds with options and to value the option embedded in the bond. Okay, let's look at something called pathwise valuation, and this is an alternative way to value a bond. But let's be clear, once we have all of our interest rates done and calibrated, we still got to do that binomial tree. But once we have our rates, rather than valuing a bond by doing a backwards induction on every single bond, we can use something called pathwise valuation. We calculate the present value of a bond for each possible interest rate path, and then we take the average. So let's go through it. Step number 1, count the number of paths. And you can think of a 10-year semi-annual bond. Well, how big that tree must be. Well, how do you possibly keep all those paths straight in your mind? How do you count all the paths? If you go back to your high school math, everybody I think in high school saw Pascal's triangle. It's a triangular array of binomial coefficients that look like this, where you take the two numbers on top, 1 plus 1 is 2, and then you add 1s on either side. So the end parts of all the triangle are 1, and here's 1 plus 2 is 3, 2 plus 1 is 3, here 1 plus 3 is 4, 3 plus 3 is 6, 3 plus 1 is 4, and each row continues on like that. So think about it in terms of what the triangle, or what our tree is. T equals 0, t equals 1, t equals 2. So at t equals 2 we have something that looks like this, where we have the value of the bond at maturity discounted back. So if we go to t equals 2, will we get 4 paths? We need 4 paths to get to the end. 1 plus 2 is 3, plus 1 is 4. So that's all you have to do, is just figure out for what level of rate you have. Look at your tree and count up how many paths there are. Here we have 4. And counting is one thing. Actually identifying all the paths can be a little bit tricky. So let's try this out and see if we get it. Let's use a 3-year 0, something nice and simple. Our 3-year rate, R3 is 1.251. So what is our discount factor here? P3 equals 100 over 1.01251 cubed will give us 96.3389. See if I can make my 6 a little more obvious. 96.3389. Let's see if we get that. With this, do we have 4 paths? This will amount to 100. Remember, it's a lattice, so it looks like this. So I have 4 paths, and you can check to see that these 4 paths are in fact what we've got. So let's see if we can get the same discount factor here. So in each case, we're going to discount back 100. In every single case, divided by. And divided by our rates, this is 1.01786 multiplied by 1.01612 and 1.01. That's just these 3 rates. We will get 95.7294. Here we'll do the same thing, 1.01323. 1.01612 and 1.01. That will give us 96.1670. And of course you could just imagine all of these in brackets multiplied by each other as the denominator in each of these cases. That's our denominator. So I'll just jump ahead right to the number. This will give us 96.5638. And here we will get 96.8915. If you take the sum and divide by 4, we will get 96.3379. And of course we're off, but I've been rounding off. All of these were rounded off, etc. Whereas this was, notice how many decimal places we went through, and it's one calculation. We have how many calculations that we rounded off. We basically recovered the price. Well, our last learning objective covers Monte Carlo simulation. It's a very short one. We actually don't really do anything, and you're not actually introduced to the methodology at all, just sort of to the language of it and what's going on and the problem that it solves. And here's the big problem it solves. Take a 30-year semi-annual bond that I have up here, 30-year semi-annual bond. That means you have 60 time periods, 60. You can imagine how big that tree is and how many rates there are and how many possible paths there could possibly be with 60. You're not going to do them all. You simply can't do it. And even if you could, even if you tried, you wouldn't want to. Monte Carlo simulation is a method for simulating a sufficiently large number of interest rate paths. There's the word I want you to focus on. Sufficiently large. number of interest rate paths, so maybe 500. And the paths are generated, whichever 500 we select, on some probability distribution and some assumption about volatility. Once those paths are selected, here's what happens. They are fit to the current spot curve. And we'll see on the next screen what we mean by they're fit to the current spot curve, because once we generate these 500 paths, that doesn't mean we have something yet. We still have to do one little thing to it. So we fit it to the current spot curve, such that the average of all paths for each benchmark bond equals its actual market value, thereby rendering it arb-free. Only once we fit it to the current spot curve do we get it to be arb-free, and we're going to see that on the next screen. When do we use this? Well, when you have a bond with far too many paths, number one, but more often you'll use it when cash flows are path dependent. And that's why we need some probability distribution and some assumption about volatility. What's the most path-dependent thing we can think of? Anything where the cash flows of the bond change depending on where the interest rates are. The most common ones that do this are mortgage-backed securities. As interest rates drop, prepayments increase. Okay, so let's have a look at the steps along the way so we could see what we mean by fitting to the current spot curve. Step number one, simulate numerous paths using, of course, our volatility assumption and our probability distribution assumption. And that probability assumption is based on how rates will evolve. We saw in developing the tree that we assumed a log normal distribution or log normal random variables in determining how rates would evolve. Number two, generate spot rates from the simulated future one-period interest rates. What does this mean? Well, if we're going to take just 500, let's say out of a possible 8,000 different paths, we're going to take 500. The chances of our reproducing the exact current spot curve are slim. So what we want to do is say, okay, well, of those 500 that we generated, what does the path of spot rates look like based on what those are saying? From that, we can determine cash flows along each path. And we're going to see in the next chapter what that means to determine cash flows. Number four, calculate the present value of each path and then calculate the average. Because we're not using the current spot rates, we're using the simulated spot rates. This is an important point. The average present value that we calculate will produce a market value only by chance. So we add a constant, something called a drift term. A constant is added to each rate on all the paths such that the average present value now equals the current market value. In other words, we fit whatever we get to the current spot curve. So it'll generate a bunch of different paths. We'll simulate a bunch of different paths. From that, we'll generate spot rates for each of the one period interest rates along the way. From those interest rates, we can determine our cash flows, calculate present value, and calculate the average, but we won't get the market price. We must fit it to the current spot curve such that the average present value now equals the current market price. That is fit to current spot curve and drift adjusted. Once this is done, we say that it is drift adjusted. We don't really need to know much more than this, just really the vocabulary. The learning objective says just describe Monte Carlo simulation. I doubt that you'd get any more than one. If you did, maybe one question on just the really broad idea of what this is, but there's certainly not going to be some detail here. I'd be surprised if you even get one question on this. All right, so that wraps up this reading. In the next reading, we are going to go right into, okay, here's a bond with an embedded option, price it out, and it really isn't that difficult. It's just one single little change in the step of backwards induction. You'll see what we mean. I'll see you there.